Hazard in insurance. A hazard is a condition or an action that increases the severity of the loss. It contributes to the likelihood of the loss happening. It affects a peril or cause of the loss. Tim falls into a car accident while driving his car at night under bad weather conditions. Tim was in a drunken state of mind. What's the hazard in this case? The hazard in this case was Tim's drunken state of mind. If Tim was careful enough to not drink and drive, he would have been alert and driven more cautiously. So Tim's drunken state has contributed to the likelihood of the loss happening. It has affected the peril, which probably was only bad weather initially causing the loss. There are three types of hazards: physical hazards, moral hazards, moral hazards. What are physical hazards? Hazards which arise due to the physical characteristics of the risk. It is a physical condition that contributes to the likelihood or increases the possibility of the loss. Bob had been smoking a cigarette at his home one evening when the cigarette accidentally fell to the ground, and the house caught fire. The house wasn't fitted with proper fire extinguishing systems as well. The physical hazard of smoking the cigarette has increased or contributed to the likelihood or severity of the loss. What are moral hazards? Hazards which arise due to the attitude or behavior of the insured. These hazards, unlike physical hazards, are not visible and cannot be assessed accurately. These are intentional or deliberate acts committed by the insured. Here are some examples of moral hazards. Drunken driving, as mentioned in our preliminary example. Dishonesty. Fraudulent claims. There are two forms of change in behavior under moral hazards: ex-ante moral hazard, ex-post moral hazard. Ex-ante moral hazard is simply a change in behavior prior to the occurrence of an event, whereas ex-post moral hazard is a change in behavior after the occurrence of an event. What are moral hazards? Hazards which arise due to lack of reasonable care taken by the insured. These are unintentional or careless acts committed by the insured. Carol has just recently purchased a new digital camera and insured it. However, Carol is careless and does not handle her camera with care. In this case, Carol's indifferent nature is a moral hazard. She knows that she is insured, but as the insurance company will compensate her for any loss to the camera. Hence, she does not really